welcome to Sinomania for the first week of February 2007. New IPOs and an IPO fund to talk about this week. First, the Good Baby Group, the biggest maker of baby carriages in the world's most populous country, is planning an IPO up to $200 million on the Hong Kong exchange later this year. The shares will be red chips, that is mainland-based but incorporated offshore. Red chips are considered to be higher quality equity investments in China. Good Baby began its IPO journey last year when Hong Kong private equity firm Pacific Alliance Group acquired majority control of the company and perhaps the first leveraged buyout in China. Good Baby is located just outside Shanghai in Jiangsu province and holds 13 international patents and commands 70% of the domestic market for baby products, so a lot of potential there. Next up, Guangzhou Port Group plans an IPO in Hong Kong late this year and may raise up to $750 million. State-owned Guangzhou Port was created in 2004 out of the assets of Guangzhou's port. The city is still best known as Canton and is the third largest port in China. Its most profitable business is oil and coal handling, which are bound to increase. And Macquarie Bank of Australia has launched a China IPO fund called the MQ IPO China Concentrated Core, a fund that gives retail investors access to institutional investor level investments in China. The fund targets Chinese companies with a market capitalization of at least $200 million and will start with an equally weighted portfolio and then rebalance periodically by replacing longest held positions with new IPOs. The minimum initial subscription will be 23,400 Hong Kong dollars, which is just under 3,000 US dollars. I'll be back with more after this break. Was Wednesday's stock performance the severe correction predicted by the China pessimists, or a necessary adjustment that shows surprising maturity and continued up potential this year? Or market reaction to conflicting clues given by Beijing regulators and politicians? The Shanghai Composite, which measures performance of A and B shares, was down almost 5% January 31st, its biggest drop in almost a year. The Shanghai and Shenzhen 300 index of leading companies was down 7%. It was a wild day, and all the major indices ended down by substantial amounts. As we cautioned last week, financials and property were hard hit. Casualties include China Vanke, the mainland's biggest property developer, which fell over 9%, while China Minxing, China Merchants, and Huaxia Banks experienced significant one-day drops. While many observers continue to warn on China, UBS springs to mind, just as many believe Wednesday's performance signals a welcome slowdown and is not a sign of imminent collapse. On Tuesday, Cheng Siwei, vice chairman of the Standing Committee of the National People's Congress, said that there is a bubble going on, but indicated that investors would, in his words, learn their own lessons. Investor protection is weak or non-existent in China, and accounts, including bank accounts, are uninsured. Comrade Cheng does not have direct authority in financial matters, but he has been influential in national politics since 1998 and has an MBA from UCLA that he got during the Reagan years. Despite Cheng's comments, Chinese securities regulators surprised the markets with a quick approval for Ping An Insurance, China's second largest insurance company, to issue over 1 billion A shares in a domestic listing on the Shanghai market as early as this month. In closing, Treasury Secretary Hank Paulson, one of the gatekeepers of the U.S.-China relationship, appeared before the Senate Banking Committee this week, where he declared the U.S. and China share strategic interests in economic growth and trade, the health of our environment, and national security. He also said he believed China's currency reform was proceeding satisfactorily and quicker than anticipated. It seems clear the Bush administration remains bullish on China. With Congress now controlled by a Democratic Party often harshly critical of the Beijing regime, how it responds over the next 2 years will be critical for U.S.-China relations. I'll see you next week.